Hi everyone. It is time for our weekly live Q&A. Elizabeth Westendorf here. I'm back again this week and excited to be here. We are going to be talking today about first time buying a house and what you need to know on the finance side. There's a lot that goes into this decision. It can be complicated and overwhelming, so we're just going to talk about the money today. I think that there's a lot to break down, right? Buying a house is exciting, but it can also end up being a big financial burden if you end up taking on more than you can afford. So the first thing to keep in mind is, what can you afford? What kind of house are we looking for? I think that you should explore a couple different lenders, get pre-approved, figure out what your options are. But when you get that pre-approval, it's probably going to be for much higher than what you actually should be spending. The bank is going to want you to take out as much money as you can possibly take out, because then they make more money off of the interest on that larger amount. It's just business. You don't want to take out that much money though. So it's easy to say, okay, I don't want to take out everything the bank is offering me, but figuring out what you do want to take out and where you do want to draw your max spending line is a little trickier. And there's a couple of things to be thinking about in that when answering that question. The first is, how much cash do you have? What are we looking at for a down payment? If you can't put at least 10% down on your house, you can't afford it. I know that there are plenty of lenders who will let you put less than 10% down. That is not in your best interest, though. It can be tempting to say 3% down because I want to own a house, but when you only have 3% down, you have no equity in that property, and all it takes is one minor emergency and you risk foreclosure, you risk losing your home. That's just not something we want to deal with. 10% down is the minimum for safety, for being financially safe here. The other question you need to answer is, how much can you afford on a monthly basis? And this is just as big of a question as thinking about your down payment upfront cost. That monthly payment is going to be something that affects you for the entirety of that loan. Hi, Lori. For the entirety of that loan for 15 to 30 years. So there's plenty of calculators online. I usually do the math in Excel, and I know the formula. I couldn't tell you the numbers off the top of my head though. Figure out what you would be paying on a monthly basis for principal and interest. Make sure you're adding in any escrow expenses for homeowners insurance and taxes, and that's your monthly cost. And if your monthly fixed expenses, which is whatever you're paying for your home, renting or mortgage, any debt payment you're doing, student loans, credit card debt, car payments, if all of that adds up to more than about 40% of your income, it's too high. It's too high. And if that's what it takes for you to be able to own a home, then it's probably not time to own a home. If your expenses if those fixed expenses add up to more than 40% of your income, it just makes everything else tighter, and you have no wiggle room if other financial emergencies come up. So I'm going to pause there. Thanks everyone who's joined so far. But if you have any questions about home buying your first house, things you need to be considering, stick it in the comments and I'll answer any questions that come through. Hi, Alyssa. The other thing that I want to talk about is your down payment. Going back to this, right? Let's say you have enough money to put 10% down, but that is all of your savings. Then you do not, in fact, have enough money to put 10% down. That down payment money has to be on top of your emergency fund, your rainy day fund, expenses, or money you have set aside for closing costs, which add up a decent amount when you're buying a house. You need to be able to put your down payment down, deal with all the costs of moving and closing on the house, and still have a fully funded emergency fund and rainy day fund. If you cannot say that, if that's not possible, then you need to save more before you buy a house. Okay, Lori asked, how does my credit score affect this process? It's a really good question. And I know we actually talked a decent amount on our live videos and in our posts about how The majority of the time, your credit score does not really matter. This is one of those times where it does. When your credit score is higher, you're going to get a better interest rate from the banks. You're going to have more options, and that's really important. This is a really big purchase in your life, probably the biggest. And so making sure that you have the best terms available on that mortgage is critical. So if you have time, if your credit score isn't where you want it to be, and you can wait to buy a house, waiting 6 months to bring your credit score up could be worth it and could end up being really financially savvy. It could save you a lot of money, especially if you're right on the border of when those interest rates pop up higher or drop lower if you raise your score a little bit. So I think that the other thing there to think about is if you're buying your first house, there are actually some really great programs out there that you need to make sure you're considering. It depends on your state and it depends on whether or not you're eligible for them. But I recently bought my first house and I qualified for a mortgage tax credit and a subsidized PMI, which is, sorry to get into the jargon, a PMI is a private mortgage insurance. And if you are putting less than 20% down, which is quite frequently the case nowadays with expensive real estate costs going up, then you have to pay this private mortgage insurance, which does nothing to help you. It is insurance for the banks in case you have to foreclose on your house. It can often be really expensive, but if you are getting in through one of these first-time homebuyer benefits, like mine was negligible, so I felt comfortable with it. And that can be something to consider. There's all sorts of other programs, depending on the state, depending on where you live and where you're buying, programs that offer down payment assistance, either as straight up cash that they give you or some sort of like secondary loan. Again, these aren't always the best options, even if they're available to you. You're going to want to judge whether or not it's a good fit for you in your financial situation. So just because the programs are there doesn't mean you want to take them. And that would be what I would say to something like an FHA loan where you could put 3% down. Just because it's there doesn't mean it's always in your best interest. So we've talked a little about what you can afford and what you need to be thinking about in terms of your liquid savings in this process. I want to take a minute to say that it is very important when you are buying a house, and again, buying a house is a really great investment. It's a great way to build wealth. And there's something very American dream about being a homeowner. That being said, it is not all rainbows and butterflies. It's important to remember that Murphy's Law is a thing. If something's going to go wrong, or if something can go wrong, it will. For example, I spent several hours yesterday trying to fix a shower clog, and by the end of it, I had made the situation worse, and there was water leaking through the ceiling of my kitchen. So if my hair's looking a little flat today, it's because I literally showered with my garden hose in the backyard. Like, things go wrong, and if you don't have the money saved after you've closed on your house and after you've paid your down payment and your closing costs to handle emergencies when they come up, you're going to feel overwhelmed, and it's going to feel, well, you're going to feel overwhelmed and things can get bad fast. So thankfully, I realized that I was out of my depth and it was time to call a professional. The plumber is coming tomorrow morning. But I know that I can handle that because I have a rainy day fund to cover housing issues that come up. And thankfully it's summer and my garden hose wasn't that bad. So Lori also commented that it's a really good point that when you buy your first house, you don't have to buy your forever home. It doesn't have to be the place where you're going to raise your kids, unless you already have kids, and that is something to be considering. But it doesn't have to be the place where you're going to stay for 30 years. You can start small. You can start with a 1-bedroom condo. You're still building equity. And as you build equity in that condo, it'll put you, or that smaller home, that fixer-upper, something that's not in the perfect neighborhood, it puts you in a better position down the line to be able to afford something that is closer to what you want to live in long term. I think this is especially important when talking about buying a house and thinking about kids, is if you're worried about being in a good school district, that really doesn't matter until your kids are 5 or so. So if you don't have kids or you young kids, you could start out in a house that isn't in the right school district and then plan on moving once you've built up some of that equity. Again, this is really going to depend on your individual situation, and it's hard to give that advice without knowing specifics, but my point is that this is not the last time you're going to be buying a property, hopefully. Hopefully this is the first step in a series of steps that involve wealth generation and setting yourself up for financial security when you're retired, and ideally won't have a mortgage to be paying. Yeah, so Kim asked, how much should I have saved for these types of expenses before buying? You mean the shower dyeing expenses and the backyard hose expenses? Yeah. So we talk quite a bit about saving for rainy day expenses, and these are distinct from your emergency savings. Emergency savings are for you have a major medical issue, you lose your job, you get divorced, you have long-term disability. Like that is, I need to replace my income, and you have 3 to 6 months of your expenses saved. The rainy day fund is for things that are smaller. If you are renting and you don't have any dependents, then a rainy day fund of $1,500 is great. That's enough to cover some of the basic things that come up, a car issue, emergency plane tickets, last minute travel, things like that. If you own a home, then you're going to want to have more saved. I would say a minimum of $3,000, though I can tell you that based on my home's history over the last 7 months, glad I have a little more than that. So $3,000 is kind of your basic minimum, and that is to cover when you have to call the plumber or the electrician or the HVAC guy, and I know all of them very well now. So if you have $3,000, then that at least gives you enough room to kind of float if things go wrong. If everything goes wrong at once, you have options if you're sitting on that much cash, and you can explore those options a lot being in a state where you are less stressed than if you had no cash at all going in. It is not fun to write checks for $500 because your shower died. But it is a lot better than putting that expense on a credit card and paying very high interest over however long it takes you to pay that off. So I think that, you could make an argument for sitting on a whole lot more cash than $3,000, but $3,000 is the minimum if you're buying a house, if you're a homeowner, in my experience and in my opinion. I think $3,000 is also the minimum if you have dependents, if you have expensive pets, any situation where you could expect to drop $1,000 or more at once. That's when you want to have a little more in your rainy day fund. And again, this is a completely separate expense from your emergency fund. And I would also say that if you happen to be in the situation where you're thinking about buying a rental property, maybe your first house becomes a rental when you move into something bigger, then you need a completely separate rainy day fund for just that property, right? The money you need to have in cash on hand keeps going up the more opportunities you have for that money to disappear, right? The more opportunities there are for unplanned expenses to pop up suddenly that need to be dealt with. And that's why you'd want a separate expense, or you'd want a separate fund for a separate property. Same thing if you end up with a bigger house or an older house, that might be the time to bump up what you're saving for your rainy day. So, okay, we've talked quite a bit about how much you need to have saved, how much you should spend and can afford when you're buying a house. Again, don't ever take what the lender is telling you is your max. It's probably going to be significantly less than that you want to be spending. And we've talked about the need to be sitting on more liquid cash than your down payment, not only for closing costs and emergency fund, but also for all of the other unplanned expenses that come up with owning a home. So if there are any other questions, let me know in the comments. Thanks everyone for joining. We'll be back next week at 5:30. Fearless Finance Associate Katie Haynes will be talking to the group. So everyone give her a very warm welcome. And I hope you all have a lovely rest of your week. Thanks for tuning in. Bye guys.